Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron discuss what it means to be fee-only and why they chose to make this commitment. AUM, hourly, and flat fees are just a few methods that fall under fee-only. They discuss the evolution of financial services and why reputable advisors may still choose to sell financial products for a commission. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So last week, Trish and I kind of shared our stories about why we chose to go independent or create our own investment advisory firms, our own RIAs. And part of that conversation was where the XY Planning Network fit into our personal stories, the XYPN. And one of the things that Trishul shared was he knew he wanted to be fee only, and XYPN fit that model very well. Whereas I found enough other things I wanted at XYPN and the help they provided, but the requirement to be fee only would have been a decision for me, because previously in most of my career I had been what other people call fee based. And today we want to talk about this, kind of what's the difference between fee only, fee based, where do commissions come into play, how do different companies, different investment companies, financial institutions make money? How do advisors get paid? And today we want to kind of talk about fees in general and how do fees work. So, Trisha, do you mind starting us off? Maybe kind of even going a little more in depth of why you wanted to be fee only for you specifically in your firm. Maybe a little bit about your firm's fee structure, because I think that's be a part of our conversation. Even within fee only, there's a variety of different types of fee only. So let's start off with your story. What does your fee structure look like, or at what point did you know you wanted to be fee only?
Right, so it's certainly been an evolution, and something I mentioned on the previous episode where this kind of came up is that when I first started this business, all I really was thinking is, hey, I have this kind of financial knowledge. It might be useful to others. Why don't I set up like a lemonade stand where people can book some time with me and they can ask me some questions and I can answer. And I really didn't think about this too hard. And frankly, I didn't know too much about how compensation worked in this business. I knew it from the hedge fund perspective where, the common nomenclature is 2 and 20. And what that essentially means is you give us $1 million, we'll charge 2% of that million, and then we get to keep 20% of profits. So that's kind of a common fee structure for the hedge fund space, or that's the common ask at least. And there are many other various incarnations of that type of model, but essentially it's a percentage of assets and a percentage of the amount of profit that you make. In this case, 20% of all profit. And again, when I started this particular venture just by myself, the notion was, how do I just charge people for advice? And I thought, hourly, just pay me for the amount of time you want, and that's how much I'll work, and just kind of let's call it a day. Again, I didn't really know all the nuances behind how commission worked on the advisory side of the business. And it's something I had to do a lot of digging into to kind of uncover. And it took some time for me to unravel everything. But essentially, in the beginning, it was supposed to be quite simple. And it is a model that is fee only. And as I learned about fee only, I realized, yeah, that's what I wanted to be, because just charging a flat fee or an upfront fee or just a fee that's disclosed that comes straight from the client made a lot of sense to me, and going down the commission path was not something I was interested in at all.
Okay, so I'm almost curious. So again, we have a lot to unpack today. I almost want to get back to the 2 and 20, because now that I seem like I knew 2 and 20 was a thing, but I never actually understood the logistics of how the 20% gets calculated and paid. Is that quarterly? Is it annually? Is it like if there's volatility within your fund, do you have to reach a high watermark? So can you like spend 20 seconds on that just for my own curiosity?
Okay, well, the high level is there's no standard. You're free to come up with any sort of creative solution you can and work on selling that to the clients or prospects. But generally, the notion is, yeah, you pay your 2%, and you do have a high watermark, meaning you got to earn at least 2% before you start getting that profit. And then the profit is 20% above your high watermark for that, call it
That'd be a
quarter.
hurdle,
That's
right?
a hurdle, yeah.
Yeah. Okay.
And let's say you're up 20% for the year. Well, first you take out that 2%, and then on the 18%, you would get 20% of that.
So you get
And
3.6 of that.
yeah, plus your 2% is 5.6% on your 20% gain for the year, which is pretty high. That's how hedge funds make a lot of money.
Okay. So is that so again? If it's if I give you $1 million, and it's up, you gain 20%. So like before fees, it's up to 1.2 million, and then you take out 5.6. You take out $56,000. So I have what are we doing? 1.945 million. No, 1.144 million. And then it goes down to 900,000. So you still take out 2% the next year. Do you have to get back over that $1.2 million number before you start collecting the next 20%? Or is
That's
it
right. Yeah.
okay? So if you got
Yeah.
from 900,000 back to 1.2 million, which is a pretty good like 33% return in year 3, but you don't collect the profits on that year's growth, correct?
Yeah, you don't get to collect that profit again because technically you already charged on that. For
Okay.
the first time they reach that money, and then you can understand how it's a little complicated because each investor jumps in at different times. So you have independent high watermarks depending on when somebody started.
Oh, that's it. Okay, that's a good point. Okay, so no more time on 2 and 20. Going back, you decided you wanted to be kind of hourly, which is a subset of being fee only. And so the big kind of subsets of fee only, the biggest one by far is charging fees on assets under management. This is the classic. You have $1 million, you go hire a financial advisor, they charge you 1% of assets under management. They charge you a $10,000 fee on that $1 million. If it goes down to $900,000, they make $9,000 next year. So your 10% drop affects their revenue as well. They had a 10% drop. If your 1 million turns to 1.1 million the following year, you got a 10% growth on your assets. Their $10,000 fee is going to be $11,000 the next year. So this is a kind of classic 1% of AUM is fee only. They disclose it up front, they tell you what it is, and it's calculated based on how your accounts grow. So that is still fee only. But you wanted to charge hourly, which is a different type of fee only. So I'm curious, why did you want to charge hourly? And I guess, was there any other consideration?
So, this was when I was at ground zero, when effectively I didn't know anything. I didn't even have a business at that point. So, it's just the first thing that came to my mind. And, when you start a business, it's one of those things where you don't need to figure everything out on day one. It's one of those things where if you have enough to get, to the next step on the staircase, it's good enough. And that's kind of where I stopped. I'm like, okay, this is something I could do. Let's just do it and figure it out later. And, I've done a lot of that with the fees in terms of, okay, let's change it a bit and then we'll figure it out later. And, I've done that 2 or 3 times since then.
Okay. So for me, at my prior firm, we were fee based. About 85 to 90% of our revenue was fees on assets under management. It was again, similar fee structure. There was actually tiers. So it started at a higher percentage for accounts under $500,000, and the tiers came down as the account value went up, and they'd be blended. But let's say, again, close enough for today's conversation, 1% of assets under management. We would also occasionally charge financial planning fees. So if someone came to us, they didn't know if they wanted to move their money over, but they really wanted our help with financial planning work, we would charge a flat one-time financial planning fee of $5,000 to $7,000. It would be probably a few months of work, and we present that. And if they wanted to hire us ongoing, again, we would transfer money over and charge fees on assets under management. If they didn't want to hire us, they didn't have to. They paid us for our time and service and expertise, and some people just moved on, wanted to do it themselves. The other component, this is kind of getting into the history of financial services, is that all the advisors at the firm, including myself, were also insurance licensed. And so this is one of those things that is a good part of the conversation, where because we're insurance licensed, it came up that if you have a husband and wife, they have a couple kids and a mortgage, and they can't get insurance through work, they really do need life insurance. This is a genuine need that every CFP would agree upon. This is a conclusion from all the financial planning. They also likely needed disability insurance. This is a very important part of protection, that if you have dependents and you have obligations, even if you don't have dependents, you still need disability insurance. If something happens to you, you need to be able to pay your mortgage. So these were extremely important. And my prior firm, and again, most of the industry, will also, because they're insurance license, sell those insurance products. And this is probably the biggest conversation within the financial advisory industry about fee-only versus fee-based. That everyone agrees, including all the fee-only financial planners, that these types of insurance are necessary. And so the question is, would you rather have your advisor who's doing the financial planning work and managing your money also be your insurance agent, where they will sell you the insurance product so that there's just one person kind of handling all of it for you? Or do you have a financial planner and pay the financial planner for the financial planning work, trying to acknowledge they also manage your investments, so you're paying for the investment management work, but you can actually go somewhere else to get the insurance done? And especially with things like term life insurance, where the actuarial calculations have been pretty consistent and the underwriting has become a little easier, there's still a bit of actual physical work. You have to meet with a nurse and have height, weight, blood draw, urine sample, things like that. But online technologies and services have made term life insurance pretty cheap. And so you don't need to go through your advisor. But for most advisors in the country, they will also collect commissions on the insurance they sell. And so these commissions are very roughly based on the total of the first year's premiums. So if there's more insurance in place, the advisor gets paid a little bit more. And this is it's been around for a while, but basically they're trying to provide all the services they could for their clients. And what happened around and I'm trying to think if I can summarize this quickly. I don't know if I can, but it's basically permanent life insurance became more of a viable product for some people. So with term life insurance, you pay a premium for 20 or 30 years. And if you happen to pass away in those 20, 30 years, the insurance company pays out. If you don't pass away, then sometimes you can keep the policy in place, but the premiums get so expensive that 21st year or 31st year that it's prohibitively expensive. And so no one really keeps a term policy after the term. And some other policies just they end and you can't keep them anyways. But some people wanted to keep insurance policies longer. And so, especially for those who had estate planning concerns. And so permanent life insurance came into play, where now you are putting more money into this insurance policy to make sure that regardless of how long you live, there's still an insurance payout. And the first kind of classic version of this was called whole life insurance, where you would put money in it and the insurance company kind of make sure that your premiums were high enough that there's still some value there, that kind of, if you missed a payment, they'd also started, okay, so whole life insurance flat out is there when you pass away, but premium's really high. They also started to add cash value. And this was what considered kind of cash or investments inside the insurance policy. And the benefit here was twofold. One, if you built up enough cash value inside the insurance policy, the cash value could make the premium payments for you and guarantee that your policy is in place for the rest of your life. So the idea is, with the first permanent insurance policies, you were paying into your 80s and 90s. And so if you're paying for that many years, it got expensive. So people wanted to, I want to stop paying when I stop working, but I still want the insurance policy to be there when I pass away in my 80s. So they created whole life insurance policies where now you can build up a cash value. The cash value pays the premiums. They have good actuarial tables saying, okay, if you have enough cash value inside the insurance policy, we'll say this guarantees the death benefit regardless of how long you live. And so we started to see these cash values. The other big benefit was, because this was a life insurance policy and the cash value was there designed to be the life insurance policy, IRS and tax code said if you make a loan from these policies, that is considered tax-free, that it gets paid off from. So kind of, if you take a loan from a cash value life insurance policy and then you pass away, that loan is paid off from the death benefit proceeds of that insurance policy. And those death benefit proceeds are always income tax-free. All life insurance death benefit is income tax-free. So the idea is that if you're taking a loan that gets paid off from death benefit, which is tax-free, that loan itself should also be tax-free. But as consumers got a little more educated, they realized, well, my cash value is only growing at a guaranteed 2 or 3%, or some kind of nominal cash value. And so it takes a lot more money of premiums going in to build up my cash value, where the cash value can pay the premiums for the rest of my life if I want to stop paying. Why can't I invest in market returns and build up my cash value faster? I get a greater rate of return inside the policy. I don't need to put as much money in, but that growth will get the cash value up to a point where my life insurance premiums can be paid from that cash value for the rest of my life. But this is kind of variable growth. So now you actually had to have a securities license to be able to sell. This was called a variable life insurance policy, most commonly known as variable universal life insurance. And so now, since all these advisors and stockbrokers who had a Series 7 had the securities license, and they could also have the insurance license, some of these variable universal life insurance policies, and then kind of the next evolution was variable annuities. One, it was a combination of the securities license and the insurance license they already had. Two, because they got paid, again, approximately that first year's premiums, and these permanent life insurance policies are significantly more than term life insurance policies, the commissions paid to the selling agent are significantly higher, usually on the scale of 5 to 7% of the money going in. And so you started to see this kind of evolution where, going back to the 70s and 80s, if you had an advisor, they're like a stockbroker. the commission was just, you want to buy this stock, I have a good stock to sell you, you buy the stock, I charge you a commission. They're kind of seeing that. They would also sell term life insurance, but the people buying the term life insurance didn't see how the selling insurance agent got paid. And so when they started combining investments and insurance in these variable insurance products, variable life insurance, variable annuities, again, the customer buying these policies didn't see how much the advisor was getting paid. And so that's where the kind of this distinction of fee only came out. It was like, at the very least, your clients need to see how you're getting paid. And so one of the kind of distinctions might have been probably, again, around late 90s, early 2000s, mutual funds started becoming more in vogue, and probably more in the 90s, where at the very least they can see it would still be a commission, but it was an A-share mutual fund charge. So it was a lower annual expense ratio, and it did make sense over the long term, but they would make about 5% up front. So it's not quite as high as those variable policies, but that was kind of the first idea of showing clients what they're paying their advisor. But even then, if the advisor kind of moved you from one mutual fund to another and you kept paying that 5%, then it didn't quite work out. So this has kind of been I try to like really sum up some of this evolution of commission was the only way. Then not the only way, because fees have been around, RIAs have been around since the 30s, but in terms of market demand, it was consumers wanting to be able to get market returns instead of guaranteed returns, and they wanted to know how their advisors were getting paid. And so this was a big push of moving towards fees on assets under management, because it kind of worked out better if there was some change in investments along the way that mutual fund commissions wouldn't work. But it was more transparent and disclosed than insurance commissions. But still, like, because all these advisors had insurance license, and again, life insurance and disability insurance, and eventually long-term care insurance, these were really important from a financial planning perspective. It was still kind of, and this is where the phrase kind of fee-based came from. Most of the revenue came from those fees on assets under management, which would be, if that's all you charged, would be fee only. But because they also sell life insurance and sometimes variable annuities and disability insurance and long-term care, again, trying to provide an additional value to their clients, they were also insurance license, also has securities license. So this is kind of what fee-based is most of it is the same as fee only, again, fees on assets under management, but they also have other ways to try and help clients. And depending on the firm and their model, and kind of, some advisors might make half the revenue from commissions. Other advisors probably, I was going to guess, more common, something on the scale of 5 to 20% of the revenue. So that's why kind of fee-based became that phrase of, yes, we're doing the same thing as those fee-only advisors, but we're providing additional services, and we get compensated for those additional services. So, Trishul, I know my summary was not that great. I know it took too long, but when you hear that evolution of incorporated insurance, where commissions come into play, and kind of definition of fee-based, is there, any question you have for me and my personal history, or any comments or questions you have on that evolution?
Well, I certainly get the evolution on how we got from there to here. And I think this notion of fee only kind of separates from that, because now we're at a time where a lot of financial products are becoming more and more commoditized. You mentioned early on where if you wanted to trade stocks, you called up your broker, and there was a good amount of commissions that got tied into just a single stock trade. And similar with mutual funds, and then of course with the insurance products. And when I started this firm, I mentioned how I wanted to be hourly, and one thing I certainly wanted to do is not go down the commission route, because what I felt like is if these products are becoming commoditized, then what's the real need for the high commissions? That was my naive take on it before really digging under the covers. And at a high level, I still kind of think that way from a few perspectives, because from one perspective, when you think about just trading stocks, we're in pretty much a zero commission world at this point. There's been a race to the bottom there. And when you think about these mutual funds and the fees that they may have, they used to have these loads and 12B1 fees. So these were fees that were paid to, to the mutual fund company and also to the individual selling the mutual fund. And they were baked into the expense ratios in the case of 12B1 fees, or they were just taken as an upfront load, or maybe even on the back end if you tried to get out too early. And the transition, something that I've mentioned a handful of times in the mutual fund industry, is to these index funds, which had lower fees, no 12B1 fees, no loads and all of that, and a race to the bottom there. And, Aaron, as you mentioned, with the insurance products, a lot of these are becoming more commoditized, as we saw with as you mentioned, with the term life insurance. There's a handful of variables and you kind of plug them in and you get a product that makes sense. And, frankly, the thought process that I went through is I would hope for my clients that I would kind of be, the first line of advice when it still came to insurance, even though I didn't specifically sell it. And the reason is because the first question when it comes to insurance is not, which product makes the most sense for a client. It's what do you need the insurance for? And I think that's a key piece of the puzzle that should be answered, because if the answer is, well, I want my kids to have $1 million and, well, let's look at the estate plan. Now, your current trajectory is you're going to have $1 million in, 10 years and most definitely in 20 years. So do you really need a whole life policy? And, the reason that same conversation is not so fluid with a commission-based model in my mind is because I feel like there could be a conflict of interest. Where it's a little easier to say, hey, well, why not just get the whole life, or why not just get the variable? And, sometimes these products in the minds of the clients seem to be investment product as well. And that's a stark distinction that I want to make, that there's a key difference between an insurance product and an investment product. Yes, there are new insurance products like the variable products you mentioned, Aaron, that have investments inside of them and they can grow like a investment. But at the end of the day, I believe its core purpose is insurance. And even though it's growing as an investment, the fact that it has an insurance, wrapper around it means that it's going to have a lot of fees associated with it, a lot of friction that would separate its performance and put it on a different level than a standard investment. The fees that we're talking about here with a variable policy, a couple that I looked at recently from a client, the fees were in the range of 3%. And the reason you see those types of fees is you might have the standard policy fee, just to kind of get the contract fee, just to kind of get the policy in force. But then you might have a rider, or that might be sensible to kind of include your spouse or something like that. But then you also have the expense ratios to think about for the investments if it's one of these variable products. And often the products that the insurance company lets you invest in, they're kind of handpicked, and they're not necessarily the ones with the lowest fees. So it's a third level of fees to think about, 1%, 1%, 1%, it adds up. if the long-term return on the market is 7%, you might be chopping yourself in half. And, that you are paying for protection, but, if you're using this also as an insurance, as an investment, you're likely doing it in an inefficient manner. So what I wanted to be for my clients is kind of like that first line of defense, saying, hey, wait, let's just talk about what we're really trying to accomplish here. And then let's go shop around for the best product that meets these needs. So rather than being, tied to a specific insurance company and, setting up, relationships with one or a handful, it leaves me with now the opportunity to say, okay, we've figured it out. These are the products that make the most sense. Now let's shop around the entire country. I have relationships that with insurance brokers that deal specifically with it, fee-only advisors. And our job is to, look at all the main insurance companies and say which one is the best. Now, you can't always go with the cheapest, but you want to check to make sure that the insurance company is reputable. There are rating agencies that help us make these determinations. But again, it just kind of opens the doors to make, I think, a more client-centric, I think, decision that hopefully reduces conflict of interest. So that's why I think even still thinking about insurance through a fee-only model made sense for me.
I think that's a great perspective. Like the removing the conflict of interest. Like even if we just looked at term insurance, okay, just term, we kind of removed the whole life and the variable from the decision-making process, and based on their mortgage, their age, their kids, what they want to provide for college, it might actually be reasonable to say, okay, and I'll do this analysis. You probably need somewhere between like 1.9 and 2.3 million dollars of insurance, and it's kind of like reflecting probabilities, Monte Carlo simulations, but it's the idea of like, okay, if you have less insurance, you might have a higher withdrawal rate if something happened to one of the spouses. If you have more insurance, you might be able to take time off work. But I'll present the reasoning why I provide this range when it's not quite clear cut. And that example, a client might decide to go with $2 million. But you can imagine if the advisor or the financial planner saying you need somewhere in this range, there's that little bit of incentive to go with the 2.3 or just bump it up to 2.5. Like, we'll make sure you have enough insurance because that incentive does exist. And again, recommending $2.5 million of insurance instead of 2.3, like, there's nothing wrong with that. There's definitely not any kind of regulatory concern. That still would be considered an appropriate amount of insurance. But you can see how, while the client might have actually been okay with 1.9 or 2, that incentive for the advisor, because they get that commission and that commission is based on selling more insurance, that conflict does exist. And I'd say the vast majority of advisors are kind of good advisors. They have their clients' best interests. And if they're going to recommend more to be conservative, that makes sense. I'm not accusing them of trying to scam their clients or acting out of malice, but I'm trying to acknowledge that incentives can influence behavior even at a subconscious level. And so I think that's why the big theme of fee only is trying to remove those conflicts of interest and trying to be as transparent as possible with how the advisors are getting paid. And so I had a couple notes what we were talking about. I want to make sure we get to the kind of expense ratios and zero commission world. But I want to finish up kind of, do you mind describing, even within fee only, kind of some of the different fee models? Like you said, you really just started hourly, but I don't think you're doing hourly anymore. You charge a little bit of AUM, I believe. I don't charge anything based on AUM. So do you want to kind of describe some of the different fee structures within fee only, or just describe your own and then I can describe mine as well?
Yeah.
So
right.
you start off at the idea of hourly. Where are you now?
Right. It's certainly been an evolution. And when it comes to fee only, there certainly is 31 flavors of, how to kind of slice it and dice it. And it's been an evolution for me as well. One thing I learned quickly after kind of digging into how these models work is something known as the retainer model. And this is the notion of having a fixed or slightly variable monthly fee where each month you pay, a couple $100 or whatever happens to be, depending on client's complexity. And given that, you can have your financial advisor kind of at arm's length. And throughout the year, you're just kind of working through different financial situations. And depending on how this model is set up, that can include managing the investments, or they can add in the investment management with a fee based upon an additional fee based upon how much investments we're talking about. So that's actually how I first launched the firm. I had this kind of a la carte model where a client can kind of pick and choose out of a menu, and there's 4.8 million permutations on how you could kind of piece this together. And I thought this would be great. Everybody can have this kind of customized kind of fee thing based upon their exact situation. It turned out to be so complicated, I couldn't even explain it to myself. So that didn't last.
I appreciate your candor and self-awareness. I had not thought of the possibility of like, oh, it was just too hard to explain to myself. This must not be a good idea.
Right. At first I thought, why make it so that a client doesn't get exactly what they need, and this will be easy. I just explain it, and everything will be magic. And it turns out I didn't know what I was doing. So it's one of those things. I graduated from the first step to the second step, but I still had a staircase to climb when it came to understanding what's really more sensible. And, one of the big issues with the a la carte model was certainly it's hard to explain, especially because even if I understand where the lines are between these various products and services, it's hard to make that clear to a client without the client actually going through the motions. So what I started to realize is also when you're dealing with a client situation, often one particular part of their financial life intersects, with another part, and that other part intersects with three more parts, and it's a web, right?
Mm-hmm.
But one thing we think about even when we're looking at an investment portfolio is an investment portfolio doesn't operate in a silo. It's tied into the client's short, medium, long-term goals. Even if it's a retirement account, it's related to their function in their financial life and their plan for retirement in terms of accumulating and decumulating assets. So everything seems to be tied together. That's what I started to realize. And what I also started to realize is, if a client just wanted something, I couldn't stop myself about talking about something else, that I felt was relevant. I didn't have the ability to kind of censor myself, saying, no, you just wanted to talk about this, so we're going to stick to this. And slowly I started to realize, what I really want to do is just help people the best way possible. So that's why I shifted to a new model where it's more of a prefix model where you kind of get everything, or like a buffet model. You sign up, and I'm going to help you in the best way possible across anything I think makes sense. And the way it kind of works now is just one fee. So you get the financial planning, you get the investment management. You can pay it monthly if you're below my minimum for AUM. If you're above my minimum for AUM, it just pays as a percentage of the amount of assets I'm managing. Again, I can explain that in a sentence, so it doesn't take a dictionary and a thesaurus to figure out exactly how it works, but that's what I'm doing now.
That's good. And you can almost see kind of that simplicity versus complexity is probably why kind of market demand has settled on the AUM model, and kind of why so many people are happy with it, because they can understand it. And for all the conflicts it may or may not pose, it it kind of works, and it's both agreeable between advisors and their clients, and they kind of everyone's happy. You don't need to, like you said, try and create that a la carte to give a custom fee to everyone when it both creates more work on the advisor's side and the clients don't want it anyways.
Right. Yeah. It's one of those things where I had at one point convinced myself that's what clients want, but I realized, wait, no, clients want their financial life taken care of. And this newer model seems to do that a lot better.
Yeah. For me, when looking at kind of assets under management versus hourly versus some kind of subscription or flat fee, I knew I didn't want to do hourly. One, because I don't trust, like kind of like you talked about, like you want to kind of talk about all the other little things that affect a client's life. For me, I know I kind of can't hold back. I can't restrain and time box my hours. So like if there's let me see if this scenario works as I'm going through their financial planning projections, I'll spend the extra time to see if that works. Or if they have a few extra questions, I don't mind if my meetings go long. And I think the biggest thing is I wanted to be the first contact for all my clients. If they had any question, I wanted them to be encouraged to reach out as much as possible. And I felt the hourly model would kind of get them to like not ask those little questions, or like, you know what, I'll figure this part out myself. I don't want to pay the extra fee to Aaron. So I knew I didn't want hourly from that perspective. Also for me, because I help clients, especially in tech industry with stock options, that tends to be my area of expertise, I didn't want to create this compensation structure where that is even that subconscious incentive to recommend that clients sell out of company stock and move it to a portfolio under my management. This actually happened quite a bit at my former firm, where if a client left a company, the default was to roll their 401k over to an IRA that we managed. And the vast majority of the time, that's what made sense for them, either from a fee perspective or incorporating investments in the financial plan or tax management. I guess for an IRA, it's not that much, but it was vast majority of the time just kind of keeping everything where we could manage it, take care of the asset allocation, made more sense than leaving it the old 401k. But not every time. And for the AUM model, for me, that's such a strong incentive that it's so consistent across the industry of, oh, you left your job, let's move your 401k over to an IRA that we'll manage, and the fees went up. Even though from a financial planning perspective, we've been providing advice on the 401k previously anyways. Now, some advisors are trying to include those 401ks in the asset under management model. So they're trying to acknowledge that we're not trying to raise fees. We're trying to, if we're managing it anyways, we incorporate that. But for me, it was between the combination of company stock, which sometimes they wanted to hold on to, 401ks, which now with mega backdoor Roth strategies, we can put a lot of savings and investments into 401ks. And then also I had a decent number of clients who would ask about paying off or paying down their mortgage, taking money out of their investment portfolio to pay down the mortgage. And I'd explain, well, if your growth rate is greater than interest rate, the net worth maximization strategy is to leave invested. But they genuinely felt comfortable. They felt happier paying off their mortgage. They knew that they were kind of locking in a growth rate equal to their mortgage, even if it's at 3.5%, 4%. I think down now, sometimes you get down to 2.5%. But they were still genuinely happier. And so I wanted to try to create a fee structure that accounted for all of the complexities and expertise that I was trying to help. And if I could kind of have a good ISO strategy, I might be able to save them $100,000 in taxes over the next few years. Like that's a realistic possibility, but it takes a lot of time, a lot of communication, a lot of planning from a kind of month-to-month, quarter-to-quarter basis, along with what does the stock price do and how do you react to changing stock prices. So some of these are pretty complex, but I didn't want to charge a fee based on asset management. And so a common thing across the industry is they'll charge a flat fee based on complexity. They'll say, instead of charging AUM, I'll take a look at your situation and I'll charge you a flat fee based on complexity. And for me, that was closer to what I was trying to accomplish, but I wanted to kind of remove that black box of complexity, at least give some people the chance, if they go to my website, they can get within the ballpark of what they think the fee would be for them. And so I charge based on income and net worth, and I do try to adjust it. I have a conversation with clients, but the idea was I wanted to be able to tell my clients at the beginning of the relationship, I'm going to charge you this much per year for the next 2 years, and you can pay either monthly or quarterly. And actually, some clients do prefer paying quarterly, so it's not just monthly. So I didn't want to be AUM, but I do include investment management with my services. So if rolling over your old 401k to an IRA that I manage makes your life easier, my clients tend to be happy to take me on that. Or if we are selling company stock to diversify, I can help them with an asset allocation strategy, and that includes tax management and low fees. And I will actually go help them kind of talk about, okay, even after my fee, because they're not paying me to just manage their investments. And if I am managing their investments, the compensation is the same. I feel that allows me to go out and look at all the options that they have for choosing their investments, and allows me to be kind of agnostic and truly a fiduciary of, this is the thing that makes the most sense for you. And so I will usually kind of show them, here's a single asset allocation ETF. Vanguard, iShares both have great ETFs. If you want to invest in just one thing, here's one ETF that'll work for you. Or we can try and incorporate 2 to 5 ETFs. And you could do this yourself, but now you have to rebalance. But we might be able to get California muni bonds instead of national muni, and we can get a little bit of tax loss harvesting. Or I can do this for you, either at the ETF level or using a direct indexing strategy. I'll try and explain the paths that they have and the fees associated with each of those, and which one I think makes best, but also which one just fits in their life better. So, Trish, do you have kind of any questions or anything you want me to elaborate on the different types of fee only, my income structure, or do you want to kind of move on to the expense ratio side of investment related fees?
Well, I currently, based upon what I know now, your fee structure makes a lot more sense to me, than my initial understanding when, I started the lemonade stand. And I think if I had to do it all over again, I probably would have started a little differently than even where I am today. But one thing I've also learned early on is when it comes to solo advisors, fee structures often do change. So I wasn't too concerned about, kind of sticking with something that I knew what I would have to stick to for life. It's one of those things where you kind of learn and you realize, the type of clients you're trying to target, the type of products and services you're trying to target. And, once that evolution happens, understanding what a sensible fee model for, one particular advisory business in terms of what makes sense, it becomes a little more clear. And that's certainly what happened from my perspective. I also had some of those conflict of interest discussions, with myself when I was going through setting up some of these models. And I do like the fact that fee only went a long way. And I do realize what you said about the AUM having some conflict if some accounts are, like not with the client at their brokerage, or, if they're like a 401k and things like that. And frankly, that there are lots of different ways to overcome that. I think the net worth model that you mentioned and the complexity model are all sensible. I think I still landed on the AUM side, but I actually do look at the 401k accounts for clients and their outside accounts, because it's something I mentioned as far as my investment management approach in one of our earlier conversations. But I like to look at the entire household for a couple of reasons. So I like to look at all of those investment buckets, because again, if I'm just looking at the accounts that I'm managing, I might be missing a good part of the equation. And with 401k accounts in particular, it's interesting because sometimes those investment options aren't necessarily allocated in the most ideal way. And aligning those investments with the overall household portfolio is something that I go for. So I try not to think about each portfolio as in a silo, but I try to think about the entire household as one kind of gigantic portfolio. And it's beneficial for two reasons. The first reason is you get to a bird's eye view of what's going on with the entire household. But the second reason is there's also some tax efficiencies that you can take advantage of from this approach. It's known as an asset location methodology. The idea here is you can shift around assets such that investments that are throwing off the most amount of taxes, the ones that are the most tax inefficient, you can shift those to the shelters like the 401k or the IRAs. And then those assets that are the most efficient, you can kind of shift those into the taxable accounts. And then once you do this rejiggering, then you can look at the overall household and make sure it's aligned as a large kind of super portfolio. And this is possible if you get that kind of bird's eye view. So that's why I do like looking at all the accounts, that a client has for this reason. And the other reason again is I've seen more often than not that the investment choices for a 401k for clients, they're not that great. Often they have higher fees, and sometimes a client will just kind of throw darts and pick things at random, such that their investments are just overlapping or highly concentrated in one area and whatnot. And sometimes I found that the employer doesn't even offer an index solution, meaning they're all kind of actively managed funds. And in the past, I've actually had to push back at the employer or the plan sponsor for the employer to say, hey, can we add in something a little more cost effective? I remember I had to do this for my employer at my first job out of my master's program. And they came in and they gave the pitch, and they showed us the list of investments. And then after they were done, they quickly ran for the exit, but I raised my hand and said, hey, where's that index fund? And they said, oh, we have an open architecture, we can add anything you want. And 8 months later, they still didn't add it. And I had left the firm, but I still kept bugging them until they finally got it in there for my colleagues who were still employed. And it's something that I feel it's important to have a good selection of choices if it's a 401k program. The employees are kind of captive to those investments, and giving them the best opportunity for success is something that hopefully I can help with as their advisor.
Yeah, and I think, again, I agree that if you're taking a look at the big picture, then yeah, it's that kind of that AUM model is okay. And I think that especially looking at the expense ratios of the funds, and I think that's one of the things I'll point out is even within so kind of like when I'm looking at investments for clients, and I'll try to present a few options, expense ratios really do matter. So this is the fee that the investment company is charging for combining all the stocks into a single ETF. Now, Vanguard's gotten pretty low. Some of them are on the scale of, I think, VTSAX, their Vanguard Total U.S. Stock Index Fund, is 4 basis points, so 0.04%. I think the international's on the same scale, so some of the fees can get pretty low. A company like a Betterment or Wealthfront, they'll still use the same ETFs, so iShares, Vanguard, Schwab ETFs, and the ETFs have their low expense ratios, but now those companies are charging a platform fee. So this would be a 25 to 30 basis point fee that Betterment is charging to rebalance and tax loss harvest and choose the ETFs and choose the alternative ETFs when you're doing tax loss harvesting. So kind of implementing the asset allocation, they will charge, again, 25 to 35 basis points. The iShares and Vanguard's allocation ETF, so again, that single single investment that has the asset allocation that makes most sense for you. This would be an ETF of ETFs, so it invests in multiple ETFs. And so there's a really small but second layer of fees. So kind of the cheapest is usually if you wanted to manage a few ETFs yourself. Then the next cheapest probably be a single ETF that invests in an asset allocation. There's a slightly higher expense ratio, but there's no platform fees. The next level would be like something like Betterment Wealthfront, where there's a platform fee and the ETF expense ratio on top of that. So again, you're probably getting to 30-ish basis points all in on average, depending on your asset allocation. In the past, there would also tend to be things like custody fees. And many custodians still charge you, especially for retirement accounts. So they have reporting requirements. They have to track cost basis. They have to report both contributions and distributions to the IRS. They send out statements, and if there's paper statements or electronic statements, just preparing these statements. So they'll charge some kind of custody fee to kind of cover these expenses that they have to do based on regulatory requirements. Although in the last, I don't know, 2 to 5 years, like you said, you talk about that race to zero, as we're almost already at a zero commission world, but things like Robinhood has really pushed Schwab and Fidelity and E-Trade and TD Ameritrade to kind of drop all of these fees down. So now, again, it's almost getting back to that kind of a la carte idea of, okay, you have your ETF expense ratios. There may not be platform fees. If you have an advisor, you have the advisor fees. You might have custody fees. You may not. And then if you don't have any commissions or custody fees, so this would be a company like Robinhood and Vanguard's pretty good. You start to ask the question of, how does this company get paid? Another example is, I think Fidelity has a couple total stock market, the U.S. but international index funds that have zero expense ratio. I forget the labeling of them, but I do know they have a few funds that have zero expense ratio. And I was wondering, do you want to kind of give a quick description of either this kind of like a la carte approach, like everything's now become more identifiable, what all the I don't want to say layers of fees, but it's like understanding what each fee is for, and then I can get back to how do companies make money if they're not charging any fees.
Right. So with the mutual funds, we talked about the expense ratios and the loads and the 12B1 fees. When you're talking ETFs, what we're talking about there is primarily the expense ratio. So that's probably the first thing you want to key in on. And a good distinction between ETFs is whether they're actively managed or passively managed. And probably a good way to tell is you just kind of look at that expense ratio. If you see something above like 30, 40, 50, this isn't an exact rule, but it's a rule of thumb. It's more likely going to be an actively managed product. Whereas if you see something below like 20-ish, it's more likely or pretty likely to be a passively managed product. And then, Aaron, as you had mentioned, those passively managed products, those fees have been going down so much that there's been kind of a race to zero. You can get like an S&P 500 passively managed ETF for 0.03% a year, something like that. And it's actually gotten to the point where you can make these trades on the ETFs for zero commissions, meaning typically in the way past, you had to pay like 1% or so, or a fraction of the amount you're trading. And then, in the world of, I guess, like E-Trade and Scottrade, when that was around, the new model was per trade, you would pay a fixed dollar amount, like $5, $10, $20, something like that. And then even that $5, $10, $20, that number started to come down to the point where now you can place a trade for almost nothing, or nothing, in many cases on the TD platform, my custodian, it's pretty much zero. And in that case, there is still something to think about. There's the spread. So this is the difference between the bid price and the ask price, the price that you can buy at and the price that you can sell at. Meaning, if you want to buy, sell, buy, sell, buy, sell, it's not at the same exact price. You're going to give up a little bit if you buy and sell the same exact thing, 10 times. Meaning you can't just keep doing tons of buys and sells without seeing some friction. And in that spread is where some money is taken out of your transaction. So even though there's a race to zero, there's also something known as the zero commission or zero ETFs, where there's actually no expense ratio either. Geez. So no trading cost, a very low spread, and no expense ratio. Now, there's a few caveats to think about there, because sometimes these zero products are proprietary to the platform that you bought them at. Meaning, if you try to move from one platform to another and it's a taxable account, you may need to liquidate that position. So that's something to think about with the zero products. Whereas a standard ETF that's traded on an exchange that you can see the price on your Google Finance or whatnot, that you can transfer from one broker to another directly without overcoming this issue. But, the difference between 0.03% and 0% over long periods of time, it's not so much at all. It's something that you probably don't need to worry about that at this point, especially if you have a long-term buy and hold strategy. It's something where you're not going to be up at night worried about, those few small basis points that, get pulled out of your investments. On $100,000, that's $30 a year.
That'd be 30 basis points is $30 a year. Did I get that right? No. $100,000. Yeah, $30 a year would be 3 basis points. Okay, sorry. So I think that's a good point. I think this is almost like understanding financial services industry a little bit. So with the zero expense ratio funds, these are actually like marketing strategies where, again, the realistic difference between 0 and 0.03% is basically noise. You can't really distinguish that. But for consumers who hear, oh, 0, this is a free fund, now it's interesting. Like that's where the value comes in. And so they actually use this almost like a loss leader, where they still have expenses related to managing that fund. They're pretty low, because these companies are pretty big and the strategies are similar to what they're already doing, and they have the same exact strategy applied to a different fund that does charge a fee, but you can move it to another platform. But if you're going to move money to Fidelity, they have a couple true zero fee, zero expense ratio index funds. Then again, if they can use that from a marketing perspective to attract customers, and those customers might use other investments on their platform, that's what the business plan is. That's what their strategy is. The other idea is that if these funds grow, because you have to sell them to move to a different platform, you can't transfer these funds in kind. If you want to move money out, you have to sell these funds, and if they're growing, there's very likely an unrealized capital gain. So if you sell them, you'll probably have to pay taxes. And so this unrealized gain, as it grows and gets built up, actually creates an incentive for people not to move out of that Fidelity. And so they might be thinking, oh, if I have to move this one fund, it'll cost me this much in taxes. I might as well leave it here. Since I already have this account open, I'll do at Fidelity whatever I was going to do at the other company. So that's the business strategy behind having these zero expense ratio ETFs. The other components that come up, there's more in the news with Robinhood was looking at order flow and net interest revenue. So we talked about that bid-ask spread. If Fidelity has enough people buying certain ETFs or certain funds or certain investments, they will sell the order flow to different brokers, and so they can actually make money on who executes those trades, and whoever's executing those trades is making these fractional cents per trade on that bid-ask spread. And so from the perspective of the end consumer, it might cost them less than a penny per share. And so again, it might feel like noise, but it's enough money in the aggregate that Schwab and Fidelity can start to, and Robinhood can make money on order flow that other financial institutions will pay for. And this is kind of feels, I don't want to say dirty, but it feels like there is front running. It's not exactly that, but it does feel like if I'm placing a trade and someone else has that information and they can make profits just off the trade itself, whether again it's that marginal bid-ask spread, then it feels like I'm getting the short end of the stick, but it's kind of the trade you're making for having a zero commission world. If you're not paying for the trade, you're not paying for the custody, this is how you are kind of getting that value. I think you even used the phrase a while ago that if you're not paying anything, then you're not the consumer, you're the product. I think that was your phrase. And this kind of falls...
I stole that, but I did say.
Yeah. And this kind of falls under that. But even though this came up in the news with Robinhood, the payment for order flow, one of the things I pointed out to friends at this time was these big companies, payment for order flow just is not that big of their revenue generator. I actually pulled up the 10K, one of the public financial reports for Charles Schwab, because it's a publicly traded company. Robinhood at the time was not a publicly traded company, so we didn't know what their internal financials were. But you can actually look this up for Charles Schwab, and I think payment for order flow made up about 6% of their revenue at sometime in 2020 when I pulled up this report. The biggest driver of their revenue, over half of Charles Schwab's revenue, comes from net interest. And net interest is when you have an account at Schwab, you have mostly investments, but you'll have some small amount of cash. You've transferred cash in, but because you need to buy shares and you couldn't do fractional shares, you couldn't invest all of it, you leave some of it in cash. And so you leave $100, a couple $100 in cash just sitting there. And that's fine because they're going to pay you an interest rate. They're going to give you a little bit of return similar to what you get at a savings account at a bank. Except that they are going to pay a fraction of what you could get if you're trying to be more competitive in shopping rates. Now, again, it's only a few $100 for you. For some people, it might be a few thousand. But they're going to pay out a pretty low interest rate. And then just like banks will lend money to mortgages and other private loans, these financial institutions can lend money in short-term, usually money market instruments or short-term debt, and they can get a little bit greater interest rate in income than the interest rate that they're paying out. So they're using your cash as kind of collateral to be able to lend money out, again, on short term. It's still fairly conservative, fairly safe, but this cash spread is what drives net interest revenue. And this is actually the biggest driver of revenue at companies like Charles Schwab. I didn't look at the financials, but I'm guessing Fidelity and I'm guessing Robinhood as well, that they're able to offer, again, no custody fees, free trades, free accounts, because they can make money on this cash spread. Because if they have enough people, enough accounts, and enough money sitting in cash, they can actually generate on the scale of billions of dollars just from these cash spreads. Again, each individual, they don't care if they're not getting their extra $5 to $10 in interest, because that just feels like noise to them. but in the aggregate, this is how they can make money. And it's not a fee. It's not something that you pay, but it's more like an opportunity cost. And it's just one of those things of fees can sometimes have a bad word, but at the very least, they're transparent. You know what the fees are. And as the fees go to zero, at least you understand, okay, how are they making money? And so that's why I always point out net interest revenue, that cash spread, is how these companies do make money. And it's kind of, would you rather pay a fee for custody? Would you rather pay 0.03 to 0.05% of the account just to have the account there? Or do you like the idea that you don't pay anything, but your cash doesn't earn anything either? And kind of collectively, society has decided I'd rather pay zero and kind of give up that opportunity cost that I don't see anyways.
Yeah, I think, just human behavior speaking, when given the choice, opportunity cost wins.
Yeah.
Versus upfront free.
That was a lot today. I have a few other notes, but I think we probably want to cut it off here before we go too long. Any final thing you want to add?
We covered a lot, so I'm glad we got through the main bulk of what we're trying to achieve with this conversation. So thanks, Aaron. I enjoyed it.
And thank you very much as well. I appreciate you describing your kind of moving up the steps of the ladder.
And thanks, Aaron. I appreciate your insight. And it's good to know that we've ended on a place that we feel a little more comfortable. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.